Hello everyone, welcome to today's webinar, proudly brought to you by Orient Futures Singapore and Singapore Exchange. I'm Linus from Orient Futures Singapore, a brokerage firm based in Singapore and a wholly owned subsidiary of Shanghai Orient Futures. It is our honor today to invite Ms. Angela Sun, Vice President, Treasury Department, Global Trading Desk, Bank of China, Singapore Branch. Angela has been market making for RMB futures since 2015, working on liquidity provision to SGX RMB products and for various other exchanges around the globe. She has extensive experience on FX and derivatives products, where she focuses on IFCC products and strategies development for the Bank of China Singapore branch. Without further ado, let's welcome Angela, please.
Hi, it's my pleasure to be invited to give you an update on what I've been asked to talk about, which is the outlook of RMB and just a look ahead into 2023. So let me start sharing. As always, let's start with the macro forecast and the macro background here and see what has changed since last time we spoke about the RMB and the economy in general. So I'll start with a macro forecast. We'll discuss US monetary policy, look at China's economic outlook out of the pandemic, and then we'll move on to an RMB outlook to see where we think will happen, will the RMB end up in 2023. So we see here that GDP growth is being forecasted to gradually slow in China. We see that it's coming away from a peak growth phase where the growth was very, very high into a more stable phase of economic growth. That is a very important dynamic that we need to keep in mind if we are looking for a longer term forecast of where the RMB FX rate is ending up. Now, if we move on to the CPI, the most closely watched economic data as of now, for the next 2 years, I think it will be the focal point of any discussion. CPI in the US has already peaked last year and is coming off from a high of 8–9%. And it will be well above 2% inflation target for the rest of the year, and possibly even into 2024. But having said that, we do see that there is a recession risk coming in for the second half of the year in the US and in other economies around the world, ex-China, so we're not talking about China here. So far, this recession risk still remains very unclear. It hasn't materialized yet. However, if we look at the employment forecast here, there will be problems ahead. We see weaker employment, which means that the Fed would need to think less about inflation and more about economic growth. We've been hearing about job cuts in finance and in tech sectors, which so far has not translated into the actual unemployment figures or the non-farm payroll. But we need to remember that both the CPI and the employment data are lagging indicators of economic conditions. So the picture is far more gloomy if we look at new orders for 2024 and beyond, which has been dropping significantly, and it's reported to have dropped all around the globe. So the question really is, how does countries like the US and China manage this slowdown in the economy? Can we assume a base scenario of soft landing to bring the economy smoothly out of the dip into the next growth phase? Or are we facing more of a hard landing, which will surely hurt the economy more than a soft landing scenario? Now, to answer that question, let's look at inflation a bit more. Now, CPI, I don't know if the audience knows about this, but the CPI basket in the US does actually get adjusted every year. And the adjustment that just happened has actually taken out a lot of inflationary items out of the equation. So what that means is just that there could be a situation where it's leading to a lower than expected CPI print in the next few data sessions. So we have a data print on the 14th, and then we have further data prints in the next 2 months. Watch that closely to see if the basket is affecting how the CPI is getting printed. And does this suggest that the Fed is lining itself up for a monetary policy pivot away from rapid rate hikes or from a tightening monetary policy into an easing monetary policy phase? Well, it could mean that, and without any surprise factors in energy prices or in commodity prices, this could indeed mean that the rate hike cycle is ending very soon. How soon? If we look at the Fed Fund futures, a very important indicator of where interest rates will end up, the Fed Fund futures, if we look at the red line here, is telling us that the peak is coming in August, and interest rate will peak around 5 to 5.25%. And then beyond that, we see a rate slowly getting lower. So we see that the peak is coming in August. We see that the implied forward rate curve is much flatter in shape than previous time points. So here the trade decision is very simple, is do you believe in an early rate cut scenario starting from the second half of this year, or do you think that the Fed will hold on? And whether the Fed will be holding on, it is depending on really just two important indicators that they look at. One is employment and the other is the inflation indicators. So now if we move on to China, we always say that inflation is not really a concern for China, but we really need to be wary of this shift that's happening as China enter a new low growth, normalized growth phase. And in that phase, inflation will become more of a target that the central bank will need to manage, coming out of a high growth industrialization phase. So what is going on with Chinese internal policy? Now, the Chinese economic outlook is really a post-pandemic reopen outlook. And if we look at internal demand and external demand, we see that the government has really chosen internal demand side as all the governmental policies, really trying to rebuild service sector, trying to rebuild the property sector. So there are a range of measures to open up quickly and to prop up the services sector. So that is your small to medium businesses, your retailers, and the tourism sectors. Now they're trying to get business back to normal as soon as possible. However, the demand may be muted at first due to a longer term lingering effect of COVID. It takes time for business to reopen. It takes time for small retailers to reopen up. And a very gloomy indicator we see is that savings has been going up very quickly. So we saw a 22% increase in savings, and that's led by the younger generation now. So we're talking about people in their 20s and 30s wanting to save money rather than spend them. On the other side is that there are pent-up demand, and the pent-up demand would be for property first and foremost, and it will likely to be released early on in 2023. So we'll probably see a rebound of the property sector. And the property sector does make up a large percentage of the Chinese economy. It makes about 4% of the Chinese GDP, which is a lot higher than the US. I think the highest point in the US, it was making up about 0.8% only of the GDP. So if we see a rebound in property sector, it will definitely pull back a lot of the municipal cities' economies. And thirdly, demand will go overseas because borders are open now. So this, it may hamper domestic spending recovery, which is something that the government doesn't want to see. Now, on the export side, we think that export will slow down because of this global recession concerns. As I mentioned before, orders are getting lower, especially going into next year and the year after that. So if industrial orders are dropping, then it's really signaling that economic conditions will likely worsen from the second half of 2023 onwards. The employment markets are still tight in the G7 economies, but any sign of the employment markets easing will signal maybe a turn in the global economy, and that certainly will hurt an exporter like China. Now let's move on to the Chinese monetary policy outlook. So the Chinese interest rate will still on schedule to slowly ease into the next 2 years at least. So that's 2023 and 2024. And the three main tools that the PBOC uses to manage the monetary policy, if we look at the three tools, we see that with the LPR rate has actually been unchanged for the past 5 months. At one point, when the PBOC cut the RR rates back in December, there was actually a period where the LPR indicating rate was higher than what the market was realizing at. But now that the reopening is happening, so the PBOC is holding back on cutting LPR. It hasn't changed for the last 5 months. And I think the cuts will come more and more cautious. In terms of the open market operations, so PBOC really like to inject liquidity on a daily basis to look at conditions every single day and to inject liquidity or withdraw liquidity out of the market through MLF and 7-day repo. So look out for any operations that is really indicating whether there is an easing stance from the PBOC in the short term money markets. For the RR rate, PBOC cut the rate in December last year by 0.25, and that released 500 billion yuan of long-term liquidity, and that brought the weighted average RRR for financial institutions to around 7.8%. So that long-term liquidity release is one of the things that we see that PBOC is really doing to try to get financial institutions to help with loan creation down on the streets. So we think that PBOC will be cautious, will try to leave room to prepare for the global economic downturn by having a slow pace of easing in the monetary policy. So it's unlikely that we'll see rapid cuts coming into the next few months. And that just means that it's good news for the RMB. RMB will be stable if there are less cuts in terms of interest rates. Now let's move on to the RMB outlook. So let's look at a few things. One is the interest rate differential. We've been talking extensively about interest rate differentials in the last few sessions because of this divergence of monetary policy between China and the rest of the world, where we have a easing Chinese monetary policy and a tightening G7 or wider global economy monetary policy. And that's been driving a lot of the dynamics in the currency pairs. Now that interest rate differential is really starting to peak, we see that the US-China one-year differential has widened to around or more than 2.5% at times now. Second is, let's look at how the spot rate has reacted to two factors mainly. One is the China reopen trade. So that's led by a lot of investors and hot money flowing into China to build up a portfolio that they left in the previous few months. So that trade has been happening for the last 2 months, and we see this rapid appreciation of the Chinese yuan as a reaction to that. And the other factor is the dollar has been weakening. So the dollar is coming off from a peak as well. So now with those two factors, it has led to a RMB comeback from a low of around 7.3 to right now the rate is ranging between 6.7 to around 6.9. If we look at the CNY CNH spread, the offshore-onshore dynamic really depends on the strength of the yuan. So the differentials widen up when the RMB is depreciating, especially when it is depreciating rapidly. So we can see actual differentials of up to 200 pips in the onshore-offshore RMB rates. And that's very important. So before any trade, I'd suggest that you look at that, and you can select a suitable site to trade on to capture that differential. Now, if you look at the swap, especially the US dollar RMB swap, we see that the swap has really started to capture this long end Fed rate cuts. So the 1-year swap point came back from around sub 2,000 pips in CNH. And also notice that the onshore, offshore, and NDF gap, so this gap between these three different swap curves has really closed up mostly. So it's reflecting a convergence of this view that rate cuts, especially into the long end, is happening. So we'll see a close-up of the interest rate differential. Now, if we look at the CNH swap curve structure, the curve structure is also replicating a peak interest rate differential in July or August for the far leg dates. But note that the swap curve is still event-driven in the short term. What that means that you can still play into a trade of a flattening or steepening swap curve in the short term. So you can hold on to a trade for a few days and play into any events that will drive short-term interest rate volatility. Otherwise, you can also look for a yield and swap implied yield difference, which we do see appearing momentarily in the market. So that is also another trade that you can look for. So to summarize, what do I see supporting the RMB, and what do I see as RMB weakness in the next few months and beyond? On the strength side, we see that the recovery post-pandemic is supporting a tighter monetary policy. So the pace of easing is really slowing down. We see a softer monetary policy in the G7 economies, which also is supporting a stronger RMB scenario. We see that the authorities actually are happy with a stable and relatively strong currency. So in the past, we always like to think that China is an exporter. So the SAFE and the PBOC would like to have a relatively weaker currency. I think that is no longer the case. because China is trying to boost its internal demand. So actually, the authorities would want to support a stronger currency in this instance. On the weakness side, we see that the hot money flowing in the past 2 months into China, into this recovery trade, that will reverse, and I think that will reverse in the next 2 months. The reverse won't be as fast as the money flow into China, but that reverse will take some steam off this RMB bull run. We'll also see softer external demand due to a global order slowdown, and that will hurt industrial production into the next few years. So if we're thinking about longer term, then that may be a problem. Internal demand recovery could be slow because of time taken to reopen business and also to create more employment in the economy. There is actually a huge unemployment issue, but it's not being noticed by a lot of market participants because China doesn't really publish a employment data that is easy to digest, let's say. And the other thing is that the regulatory environment will still be uncertain going to the next few years, although we do see that the government is trying to help industries and trying to help tech and property, which were the previous 2 sectors that really got hits from some of the regulatory scrutiny. So how does that really translate into where the RMB will end up? Now, slower pace of rate cuts will support yuan. Softer G7 monetary policy will support yuan. Yuan is not much changed against a basket of currencies, as shown in the CFETS index. So actually, if we think about all the different factors affecting the RMB, it will likely to be balanced. That's why we think that the RMB will likely be range trading, which is in line with the SAFE's reiteration of having a stable 2-way volatility in the yuan. So really look for 6.7 as the pivoting point. So any break below that may lead the way to further gains towards around 6.5 or recover to around 7 with strong US CPI or employment data. That's all from me. I think Lennis has some questions.
Okay, thank you, Angela, for your valuable insights. Okay, now let's go to our Q&A session, whereby we have received some questions earlier. Okay, the first question for Angela. How is the pandemic situation in China? Will it still be affecting RMB?
Very good question. So how is the pandemic situation? So it's very surprisingly and amazingly, China has managed to go through the whole pandemic in 2 months. So around 70 to 80% of large cities' populations got infected in late November towards December. So before Chinese New Year, pretty much the pandemic was over. So I don't think it will be a factor affecting RMB very much now. If the situation is still stable, if we don't see any new variants, which I don't think we will see anymore, it seems like this really fast reopening has taken the virus by surprise as well. So I think the worst is over. Everyone is on course to going back to full production. So no, I don't think pandemic will become a factor anymore.
That's good to hear. Okay, second question. What are the main risks you see in the market?
So the main risks, I think the main risks are still coming from recession or this expectation of a recession. So we see there are problems in the employment markets, and actually outside of any inflation data, employment is really where all the fiscal and monetary policy is targeting. Now, any sign that employment market, this whole tightness that's been happening for the last year and a half is really easing up, then governments around the globe will have to think about how do we manage this next economic cycle. So now we're still in a bit of a euphoria that the economy is recovering so well and employment has recovered so well. I think it's record low unemployment rates in a lot of places around the world now. So recession risk is still there. And of course, there is this risk of unstable geopolitical events. But personally, I don't think that will materialize in 2023, but it is a risk factor. And what we don't want to see is any escalations in terms of this friction between different countries in different geopolitical locations. So I'll just stop there, just a little hint.
Okay, and what's your view on recession, soft or hard landing?
Okay, I think we were talking about soft or hard landing, but I never really communicated my view on that. I was in the previous session, so last year I was really thinking maybe this will be a hard landing. I was thinking that this time with very high inflation, then the central bank's hands are actually tied, trying to bring inflation back in check. Now, there are different voices on the market. So some voices are saying actually maybe the central banks and the governments around the world will try to tolerate a higher rate of inflation. So maybe they'll even drop the 2% target. So that actually is in favor of trying to manage for a soft landing. Now, will they actually drop the 2% target? I don't think so, but it could be a situation where they'll say, we are happy with a higher rate of inflation, and we are happy for that to stay for a longer term than we were expecting. So that's why we see this pivot away from a very hawkish monetary policy. And I think maybe the situation will be that in the second half of 2023, we'll see central banks holding back on any rate cuts or rate hikes, and being happy with inflation that's well above 2%, so maybe 3 to 4%. If they can manage that delicate balance well, then I think we can expect a soft landing scenario, which is what everyone wants.
Okay, so thank you, Angela, today, for your valuable insights. And with that, we have come to the end of our webinar. Do stay tuned to us for upcoming webinars. And if you would like to reach out to us, do visit our website at orientfutures.com.sg. Okay, thanks everyone. Thanks, Angela.
Thank you.